The number one query I get is around capital gains and how they're treated as an overseas resident compared to when you live in Australia. Tristan, capital gains tax. I know it's the number one tax query I get from clients. I'm almost certain it's the number one query you get as well.
Definitely something I talk about every day of the week.
Yes. So very excited to have you here to help break it down for us.
Thank you.
Probably let's start from the top and get some context. What are the biggest differences between being a non-resident for capital gains versus being a resident for capital gains?
So really good question. So working through the list of the key kind of differences is the first one is the 50% capital gains tax discount. Mm-hmm. So this is a concession that Australian residents receive when they sell a capital asset like a property, where effectively you cut the gain in half. Non-residents miss out on that, and that was a change that came in on the 8th of May 2012. So largely speaking, for a expat who has purchased and sold a property whilst they're being offshore, they miss out on the 50% capital gains tax discount altogether. But for someone who has owned a property previously or has purchased a property offshore and brought it back home, you would qualify for a partial 50% capital gains tax discount on a straight line method.
So basically, while you're offshore, the government wants as much money as they can from you.
Exactly.
If you sell a property.
Exactly. And it gets a little bit more tricky if you've owned the property on the date of the change on the 8th of May 2012. We need to get a valuation. But long story short is, unfortunately, you do miss out on that major concession, which is a big one for a lot of Australian residents.
Definitely.